We're not talking about chatbots today. We're talking about power, the unsexy infrastructure behind the AI boom. In today's video, I dig into how the build megawatts and they will come play is starting to resemble the 1990s CLEC fiber craze. The truth bomb? Just because you can dream capacity doesn't mean the market will pay for it. Yet. I remember open ocean swims, waves crashing, currents pushing, your goggles literally getting ripped off your face, swallowing gulps of salt water with each breath. You swim hard, you stay on course, and you try not to panic when you can't see the buoy. You stroke, and you keep moving, and you keep your head down. Yesterday felt just like that, but not in the market. It was during market hours, sure, but it was about me doing something else that still felt like I was wading through rough seas. One of my favorite writers at Bloomberg pinged me to comment on Oklo's sharp intraday decline. I saw the message on my Bloomberg terminal. It sat there unanswered because, well, I was swimming. Now, you all know that I'm a huge fan of the AI ecosystem. Call it an investment thematic. Everyone wants in on that. It's a once-in-a-lifetime productivity wave, and that's fine. But I spent a lot of time refuting the simple claim that we're in a repeat of the dot-com bubble. No, we're not there. And I mean not the dot-com 2.0 bubble. But here's the twist. Mostly not. The AI ecosystem is vast. Security, semiconductors, power generation, servers, software, services, you name it, it's there. We've moved from wide to deep. More players at the fringe. Some got novel ideas, most are copycats. A few have wild ideas that have a near zero chance of even working. And these wild ideas, well, they creep in because investors are hungry. They're hungry for the next big thing. Then basic investment principles, they get forgotten. Sound familiar? Pictures of pets.com flash in your mind yet? But here's where I cease my defense stance and I pivot to something that's starting to feel like a bubble, but a different kind. The competitive local exchange carrier, or CLEC boom of the late 1990s. Yeah, I know it sounds like ancient history, but the parallel is spooky. Back then, the internet was the AI of its day, transformative, disruptive, and full of promise. Every telecom exec was telling investors that bandwidth demand would grow exponentially forever. Fiber was the new oil. Companies raised billions for underground cable, rural fiber, undersea cables, the works. Every new entrant promised their share of the digital future. And the more fiber they planned, the higher their stock price went. Guess what happened? By 2001, the US had more dark fiber than it could ever use. The gold rush turned into a field of abandoned mines. I remember the psychology. No one wanted to miss the next big thing. Analysts justify astounding valuations with total addressable market models stretching decades into the future. Banks underwrote the deals, retail investors folded in, and momentum, it took over. Everyone wanted in. Does that sound familiar to you? What I see now, the AI power trade. The narrative, AI will reshape everything, but it needs power. Lots and lots of power. And power is scarce. So whoever builds it wins. There's truth in that, but not all truth is investable at any price. Building power capacity is capital intensive. It's slow, it's politically complicated. You don't just spin up data centers or grids overnight. You need permits, transmission infrastructure, water access, even new technology in some cases. Timelines can stretch on for years. When too much capital chases the same bottleneck, guess what happens? Shortages turn into glut, and gluts end cycles. The CLEC bubble didn't burst because the internet failed. No, it burst because too many people tried to monetize the same opportunity at once. The survivors weren't the dreamers. They were the scavengers who bought the bankrupt networks on the cheap. And that, in my mind, is where we are today. I mean, take Fermi's IPO. Not because I think the company's bad. It has vision, but what it represents is the issue for me. It's a pre-revenue power company trading like an established utility. That means we're all assuming demand will be infinite and execution risk doesn't even matter. When my Bloomberg friend pinged me about Oklo's decline, it wasn't just one stock. It felt like a crack in confidence. A single TV comment from Jim Cramer questioning Oklo's fundamentals triggered a chain reaction. That tells you just how fragile this trade is. When story, not cash flow, drives valuation, it doesn't take too much to topple. This doesn't mean the AI revolution isn't real. It is. It's very real, just as the internet was real in 1999. The question is one of timing. Fiber eventually became the backbone of the digital economy, but not before investors were wiped out building it. AI will change everything too, but not everyone racing to power it will make it to the other side. The AI economy will need more power, more servers, and more grids, but maybe not as much, and certainly not as soon as some are banking on. The capital build-out we're seeing with microreactors, new REITs, massive data center campuses is happening at a pace that markets historically can't sustain. Infrastructure doesn't grow linearly. It lurches forward in bursts, then pauses while demand catches up. Right now, we're sprinting into the unknown, assuming AI's appetite will never level off. Well, guess what? That's what the fiber crowd thought too. I'm not saying this is a bubble, but some symptoms are appearing. Pre-revenue companies trading like utilities, speculative SPACs dressed up as infrastructure, retail traders buying AI power tickers like they bought .com tickers. Even the language feels a little recycled. Capacity, explosive, demand, bandwidth, replace fiber with megawatts, and you've got, well, the same pitch deck that I saw years ago. Yet, I end on an optimistic note. Not all fiber builds were bad. The overcapacity of the early 2000s became the pipes for the next era. Broadband, streaming, cloud, the pain financed the pipes that made everything possible, ultimately. In that sense, even an overbuild in energy infrastructure might not be a total loss. The world will always need more power, even if it's not immediately for AI. The winners will be patient operators who buy the leftovers after the frenzy fades. So I'm not calling this a bubble just yet. I am saying be selective. There are companies with real earnings, real cash flows, real prospects, and then there are those floating on narratives. The difference isn't always clear at the moment, but history has a way of drawing sharp lines when the music stops. We've seen this movie before. It doesn't end in catastrophe for everyone, but it does humble those who forgot that markets, like ocean races, don't reward panic. They reward endurance, discipline, and the ability to keep your bearings when visibility fades. Stroke, stroke, stroke. Keep swimming toward that buoy, even if you can't see it yet. Don't worry, it's there. So your truth bomb for today is this. Only invest in power to service AI when you prove that you can build it and sell it, not just promise it. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.